Every Sunday night at exactly 6:00 p.m. Eastern Time, something happens in the global financial markets that Wall Street does not want you to understand. The futures markets open, and in the first 60 minutes of that opening, the most powerful financial institutions on the planet reveal exactly what they know, exactly what they fear, and exactly what they are positioning for before you wake up Monday morning. And right now, that signal is doing something it has only done 3 times in modern financial history. Something that preceded every major market collapse, every currency crisis, every moment where ordinary people woke up one morning and discovered that everything they had saved, everything they had built, everything they had trusted was worth dramatically less than it was the night before. This is not a theory. This is not speculation. This is a documented, observable, mathematically measurable signal sitting in publicly available data that 99% of people have never been taught to read. And the people who do know how to read it, the hedge funds, the sovereign wealth managers, the institutional traders who move billions before sunrise every single Monday, they are terrified right now. Because the signal is not just flashing, it is screaming. And while you were going about your weekend, while you were having dinner, watching television, spending time with your family, the smartest, most connected money in the world was quietly repositioning away from everything you probably own. By the end of this video, you will know exactly what this signal is, exactly what it is saying right now, and exactly what history tells us comes next, because the pattern is clear, and it has never been wrong. Most people have never heard of the Sunday night futures open, and that is exactly how Wall Street prefers it. Every Sunday at 6:00 p.m. Eastern, before any bank opens, before any stock exchange rings its bell, before any financial news anchor sits down in front of a camera, the futures markets come alive. S&P 500 futures, Treasury futures, dollar index futures, gold futures, oil futures. All of them begin trading simultaneously in the dark, while most of America is still finishing the weekend. And in those first 60 minutes, something extraordinary happens. The institutional money, the money that manages pension funds, sovereign wealth, generational family fortunes, begins moving. Not randomly, not emotionally, systematically, calculated, with information and intelligence that retail investors simply do not have access to on a Monday morning. Here is what makes this signal so precise. Futures prices on Sunday night reflect what the largest, most informed institutions in the world genuinely believe is going to happen. Not what they say on television, not what they publish in press releases, what they actually believe. Because they're putting real money behind it, billions of dollars, moving in one direction before the sun rises. And right now, every single Sunday night for the past several months, that money has been moving in the same direction. Away from dollar-denominated assets, away from U.S. Treasuries, away from American equities, quietly, systematically, without a single headline. The signal is publicly available. You can see it yourself. But knowing what it means, knowing what it has meant every single time it behaved this way throughout history, that is what changes everything. And that is exactly what I'm going to show you right now. Now, to understand why this signal matters so much, you need to understand the pattern it has triggered every single time it has appeared in modern financial history. Because this is not random market noise. This is not normal volatility. What we are watching unfold in the Sunday night futures markets right now follows a precise, documented, 4-stage cycle. The same cycle that institutional money has followed every single time it has sensed systemic risk at the highest level. Same stages, same sequence, same devastating outcome for the people who did not see it coming. Stage 1 is accumulation. The smart money begins quietly building positions. No announcements, no press releases, just slow, systematic, almost invisible movement in the futures markets, in the options chains, in the credit default swap spreads. The public sees nothing, the media reports nothing, but the signal is already there for those who know how to read it. Stage 2 is acceleration. The positioning becomes more aggressive, the signal gets louder, more institutions follow the first movers. Capital begins rotating out of vulnerable assets faster, still no headlines, still no panic. But the mathematics are becoming undeniable to anyone paying attention. Stage 3 is the exodus. This is where we are right now. The signal is no longer subtle. The moves are large, frequent, and consistent every single Sunday night. The smart money is not testing the exits anymore. They are using them. Stage 4 is the consequence. The moment the signal reaches critical mass, the Monday morning that changes everything arrives. And by that point, it is already too late for anyone who was not positioned correctly. This cycle has played out before, 3 times. Let me show you exactly how. October 1907. The most powerful banker in the world, J.P. Morgan, is sitting in his private library on a Sunday night in New York City. Outside, nothing looks particularly alarming. The streets are quiet, the newspapers are calm, but Morgan is not calm, because Morgan can read the signal. And what it is telling him is that by Monday morning, the entire American financial system is going to begin collapsing. He had been watching it for weeks. The call money rates, the precursor to what we now track in Sunday night futures markets, had been moving in a specific, unmistakable pattern. Trust companies were quietly reducing exposure. National banks were tightening lending. The smart money was already repositioning. And the public had absolutely no idea. By Sunday night, Morgan had seen enough. He summoned the most powerful bankers in America to his library and locked the door. Literally locked the door. He told them they were not leaving until they had committed enough private capital to stop what was coming. $25 million pledged in a single Sunday night meeting, the equivalent of over $800 million today. But here is what history never emphasizes enough. While Morgan was saving the system from the inside, ordinary Americans were being destroyed on the outside. Banks suspended withdrawals. People lined up around city blocks to access their own money and were turned away. Businesses collapsed overnight. The stock market lost 50% of its value in weeks. The signal had been there, publicly visible to anyone who understood what they were looking at. But nobody told ordinary Americans how to read it. Nobody warned them what was coming. Stage 1 complete, Stage 2 complete, Stage 3 complete, Stage 4 devastating. Exactly like the pattern predicted. August 15th, 1971, a Sunday night. Richard Nixon sits in front of a television camera and delivers the most consequential financial announcement in the history of the modern world. And he chose Sunday night deliberately. Not Monday, not Tuesday, Sunday night, when the markets were closed, when ordinary Americans were relaxed, distracted, unprepared, when there was absolutely nothing anyone could do until Monday morning. Now I know exactly what some of you are thinking right now, because I have heard it before, and I want to address it directly, because these objections deserve honest, historical answers, not dismissal. The first one is this: markets always recover. The Fed will step in. They always do. And to that I say, you are absolutely right that they have stepped in before. J.P. Morgan stepped in during 1907. The Federal Reserve stepped in during 2008. But here's what that argument misses completely. Stepping in did not protect ordinary Americans. In either case, the system was saved, the people were not. Banks reopened in 1907, but the businesses that collapsed while they were closed never came back. The stock market recovered after 2008, but the 6 million people who lost their homes never got them back. The institution survives. The individual absorbs the damage every single time. The second objection is this. This has been predicted before and it never happened. Doom predictions are always wrong. And again, I understand why that feels true. But what I am showing you is not a prediction. It is a pattern. Spain did not predict its own collapse. The Dutch Republic did not see its own end coming. Britain did not believe its empire could fall. They all said the same thing. This time is different. We are stronger. We are too important to fail. They were always wrong. The mathematics were always right. The third objection. The dollar is too important to lose reserve status. The world needs the dollar. So did the world need the Spanish real in 1550. So did the world need the Dutch guilder in 1700. So did the world need the British pound in 1950. The world moved on. It always does. The pattern does not negotiate. So based on the pattern, based on all three historical examples, based on what the Sunday night signal is showing us right now in real time, let me tell you what history says comes next. Not what I think, not what I predict, what the pattern has shown every single time without exception. The signal reaches a tipping point. It has happened at different speeds in different eras, but the mechanics are always identical. The institutional exodus that is currently happening slowly, quietly, systematically, begins to accelerate. The Sunday night futures moves get larger. The Treasury selling gets heavier. The dollar index begins showing consistent weakness at the Sunday open week after week. What is currently a controlled, deliberate repositioning by the smart money transforms into something faster, something less controlled, something that starts pulling retail investors and foreign central banks into the same current. And then one Monday morning, the move that has been building for months becomes visible to everyone simultaneously. Not gradually, not with warning. Suddenly. The way it was sudden in 1907, the way it was sudden on August 16th, 1971, the way it was sudden on September 15th, 2008. The people who were positioned correctly that morning experienced a completely different reality than the people who were not. Dollar-denominated assets reprice. Savings accounts that felt secure begin losing purchasing power faster than interest rates can compensate. Stock valuations that were built on cheap money and artificial liquidity begin reflecting something closer to reality. And the middle class, which holds the majority of its wealth in exactly these assets, absorbs the impact first and hardest. This is not speculation. This is the pattern. And the pattern has a perfect historical record. 3 for 3. Same signal, same stages, same consequence. The only variable is whether you see it coming. So what do you actually do with this information? Because fear without action is just anxiety. And anxiety never protected anyone's wealth in any collapse throughout history. The people who survived these transitions, who actually came out the other side with their financial lives intact, did not just understand the pattern. They acted on it. Specifically. Deliberately. before the Monday morning that changed everything. The first thing you do is look honestly at what percentage of your total wealth is sitting in dollar-denominated assets right now. Savings accounts, dollar-based retirement funds, U.S. equities, domestic real estate priced in dollars. If that number is above 80%, you are carrying the same concentration risk that destroyed middle-class wealth in 1971 and again in 2008. Diversification is not a suggestion at this stage of the signal. It is survival mathematics. The second thing is to understand what has actually preserved wealth across every single one of the collapses we examine today. Gold held value through Spain's defaults. Gold held value through Britain's devaluation. Gold held value through Nixon's Sunday night announcement. Hard assets that cannot be printed into existence by a central bank have a 5,000-year track record of surviving exactly what the signal is currently warning about. The third thing is to reduce leverage immediately. Every point that interest rates rise from here makes existing debt exponentially more expensive to carry. The institutions repositioning right now are not borrowing more, they are deleveraging. Follow the smart money, not the narrative. The fourth thing is the most important. Stay informed. The people who saw 1907 coming, who read the 1971 signal correctly, who understood what September 2008 meant before Monday morning, all had one thing in common. They were paying attention to the right information before everyone else was.